So let me show you how I think the markets work. There's some timing things we can use. We're going to talk about some technical things, but mostly fundamental things in the marketplace. This is the decennial pattern, first written about by Edgar Lawrence Smith in the 1930s. And basically he said years ending in 2 and 3 are when prices tend to rally in the marketplace, and they tend to top out in years ending in 7s and 9s. You can see where we were last year ending in 2. We're getting up into this time period. We have a low in 2018, and way back in 2000, coming forward in 2022, we're probably close to a significant low in the marketplace. So for a long-term perspective, I really like to use the 10-year decennial pattern. And many of you have heard me lecture about that. It's nothing that's going to say buy today, but it gives me perspective of where we are in the move. And it doesn't necessarily mean we're going to crash. It just means these are my better buy points along the way in the marketplace. And I'm going to show you some specifics that are really powerful we can use in that. But if we look at the years change by each year in the decade, the years ending in 5, like where we are, 2015 has been the strongest. Those years have returned 254%. 8 years have been good, but look at years ending in 0, minus 36%. And coming up, ladies and gentlemen, years ending in 7, minus 74%. Years ending in 7 have had some really big sell-offs in the marketplace. Oh, 2015 now, 2017 is coming up shortly, isn't it? So we know, I believe, there will be a significant sell-off in 2017. That's one point I'm going to get bearish, for sure, because I'm not a perpetual bull. Just because I was so bullish this morning doesn't mean I don't sell short or move to cash. I clearly will do that when the evidence says that's what I should do. Gary? So this is the average of all years ending in 5. It's really interesting. From 1795 to 1895, 200 years of information there. And on balance, this is what gets really interesting. In August of years ending in 5 is when markets start to rally the most. So we're in 2015 now. We had a big sell-off in August. It set up a buy point, and you'll see my forecast for the rest of the year later today. This is probably about where we are on a long-term basis. You can break down each year in a cycle. I'll talk a little bit more about that as well, but that's probably where we are now. So when you're watching this video in 2025 or 2035, I'm going to be bullish wherever I am, alive or dead. I'll be channeling from outer space, telling you to buy stocks if need be. So that is the strongest year of the decade. There's clearly a decennial pattern. You really need to understand the impact of this pattern. This is the average of all years ending in 7. That's a pretty strong algorithm, isn't it? They usually get really strong, everybody's happy, rock and roll times, heaven is here, and then about July, August, they just fall out of bed. The only exception was 1927. Other than that, all years ending in 7 have had significant sell-offs, and almost always in July, August. Why? I don't know. But I've noticed this often enough. Some of you, we could go back and look at charts going way back in history, or you could just recall 2007. What happened in the middle of 2007? The bear market began, didn't it? What about 1987? Oh yeah, we all know that one. Or 1997, or 1977. The middle of years ending with 7, for whatever reason, are exceedingly bearish time periods. So my view is, as I get into that time period, I'm looking for cash, I'm looking for the off-ramps, fastened up the seatbelt, because that's a really negative cyclical point in stock prices. I don't want to be holding a whole lot of stocks starting in July of a year ending in 7. It's a general timing idea. So why would we have this decennial pattern? I'm not certain, but this intrigues me. The black line you see down here are solar flares, sunspots. There's a strong 10 to 11 year pattern in solar flares. Notice when solar flares have lows, the Dow Jones Industrial Average, that's the gray line, also has lows. When we have highs in solar flares, we start to sell off in the stock market. Lows, lows, highs, lows, and highs. There seems to be a solar influence of stock prices. Because I was like, no, why are these things happening? A question? How do you know when the solar flares? A, they're very predictable. You can go to a variety of government websites and they'll show you the solar flare cycle right here, right now. So you can Google that, they're all over the place. And that's not astrology. Let's be real clear about that. This is a phenomenon that happens. It does a whole lots of things. It affects communication, television, airplane pilots. Everybody is affected by solar flares. And some are massive. We just had a very large one recently. Well, that's stock price. Now, what if we looked at another thing? What if we looked at gross domestic product and sunspots? So sunspots are the black line, and GDP is the gray line. Look at the correlation again that we see. Lows in solar flares, highs in solar flares, lows in solar flares, and highs in solar flares. It looks like GDP is also influenced by a cause that has about a 10-year cycle in it. And I'm obviously not going to buy IBM because of the solar flare cycle, but it gives me an understanding of why the decennial pattern is as strong and has held up so long. I mean, after all, I first read about this in 1962. It was written about in 1930, and it continues to hold up. Without the 2002 bottom, the 2012 rip-off point in the stock market, the 2007 sell-off in the market. So this has really held up for a long time period. There's some causation here, I think, and I just like to know what causes things, as opposed to the technical mumbo-jumbo. I don't think that a lot of technical stuff works very well, frankly. I like to get to the cause, the fundamental condition. I think that's probably the condition of why we have this decennial pattern taking place in stock prices. And of course, if it happens in stock prices, it would affect commodity prices. It would affect economic growth, and it seems to be worldwide. Now, the data for much of this, interestingly enough, comes from the Federal Reserve of the United States of America. This is not from Astrology Today magazine, but the Federal Reserve has written extensively about the effect of sunspots on the economy. Harry, if you would. There's also another strong pattern. Why don't you just click on that? We'll go to new slides. No, just stay there, but if I do that, you click. There's also a very strong 4-year pattern in the market, but I want to teach you how to use this pattern because it's just not a totally repetition, but it's close. But here's how to use it. This is the 4-year pattern in 1928. Look what happened to stock prices. Whoa, they just screamed. 4 years later, hey, major market low. 4 years later, again, we get a scream in the market. 4 years later, 1940, bull market begins again. About every 4 years, we've seen significant buying points in the market. Now notice, it doesn't necessarily mean that we're going to have a decline. It's more about a buy point here, a buy point here, and a buy point there. And we can see that continue happening. And it isn't like we come into a low, but we're close to a real big rip-off to the upside in the marketplace, where prices just accelerate about every 4 years. The best way to use this, though, is to just find the last 4-year low and come out 4 years from there. Notice this was a 4-year low. It wasn't perfect in our cycle, so we just come out about 4 years, and then we're into the correct time period. So I just let this move along because the markets move back and forth a little bit. And so I just look at the last major low and come out 4 years from there, and that's where our next low is going to be. You see this moving forward. There was the 1962 low. This is when I first got it. I had made my first fortune in the market selling short here. I'm over $1 million before I was 30, but I covered my shorts up here. Way too late in the game. One night I'm looking back at my charts and thinking about when I began trading in 1962, and 4 years later there was a low in 1966, and 4 years later there's a low in 1970. I thought, wow, I wonder if there's any 4-year thing going on. And of course went back 4 years from 1962 and I saw this happen, and I saw what else you've seen, and that's when I fell in love with the 4-year pattern, way back in 1970, long time ago. So how has that moved forward in time since I first saw it? Well, there was the 1970 low, 1974 low, 1976 low, 1982 low, the start of the largest bull market in the history of America. on cadence with that 4-year phenomena. As we come further in time, you can see what's happened. Whenever we've had that 4-year phenomena kick in, we've seen massive stock market rallies. There, look at the huge rally that began. And we'll go to our next chart, Harry. And we continue to see that phenomena. The last big move up into the top almost looks like 29. Suddenly, stocks are holding along and they rip to the upside. Why? Because there is the 4-year cyclical low in stock prices. So this is a time you want to be fully invested. Don't be negative. Don't be worried about things. You know, you can go home, buy your stocks, hop under the covers, turn the electric blanket up to 9, assume the prenatal condition, and stay there. Just stay there. This is when you fall asleep and forget you had an account at the brokerage firm. Well, look what happens 4 years later. 2009, the low. 4 years later, again, we rip off to the upside, and we have in 2017, we're entering a 4-year low. Exactly when? Well, let's go back to the last 4-year low, and we can move that forward to about when that's going to happen. Probably, because we know what happens in years ending in 7, that decline in 2017 is going to set up the 4-year market low. And you'll be able to continue doing that on ad infinitum into the future. Just take the low, if it assumes it comes in 2017 and say October, come forward 4 years from there. And that's when you'll be looking for your next 4-year market low. When that takes place, come 4 years from there. That'll be our next significant market low. About every 4 years, you want to be fully invested in stocks. And it doesn't mean the market will come down, it did here, but it may also mean we're just holding up, and suddenly, out of the blue, prices scream to the upside. That's the 4-year phenomenon. So don't think prices must come down. They may be holding up. Please.
Larry, have you related these changes to any breaking a certain moving average?
Have I related these to any moving averages? No. When we talk about buying, I'm going to show you my buy indicator that's based on rate of change, but it's not moving averages. There's been some really interesting studies done on moving averages recently by a couple universities, and the bottom line of the moving average studies, A, they don't work, and B, the shorter term the average is, probably the better it's going to come to closer working. But moving averages to me are just a tool. They help see something, but there's no magic to any of them at all.
Larry?
Yes?
Which one is the stronger, the 7 years or the 4?
Hold on, doctor. Yes?
Which of the patterns is stronger, the 4-year or 7? Because 2017, according to the 7-year pattern, you should be going down in July or something. But here, you should be going down end of January.
So the question is, Larry, I'm a little confused. The 7-year shows that we have a sell-off coming, and the 4-year says there's a buy. Well, the buy of 4 years is kind of general, so we need to go back to the last 4 years. But obviously, my view is 2017 will have a big decline, then that sets up the 4-year buy. So the decline comes, then the buy comes. That's what I'm looking for in the market. So on a long-term basis, if we look at long-term market timing, years ending in 2 are buy points. 2002, 2012, 1962, 1932, 1942. They're all buy points in the marketplace. A little interesting history on that. Years ago, there was a guy named Howard Ruff. Any of you older people remember Howard Ruff? Yeah. Howard wrote a book, How to Prosper in the Coming Bad Times. Howard was never happy in his life, never had a happy day. He was always negative on everything. So I was standing in a grocery store shopping line, and I see this book by Howard, who I knew Howard, How to Prosper in the Coming Bad Times. You know what? I'm going to write a book, How to Prosper in the Coming Good Times. So Regnery Gateway published it. We published it in 1981, and we called for a major market low in 1982. Not because I'm a smart guy, but because I knew about what bottom in years ending in 2. And sure enough, we had that largest bull market in the history of the world took off in 1982. Well, I got bored, traded, and in 2001, I thought, you know what? 2002 is coming up. It's time for another book. So I contacted my publisher. I said, I got a great idea for a book called Blast Off, The Coming Bull Market. And we'll get it published in 2002. In fact, go back to the big chart we just saw. Perfect. And so they got the man, oh yeah, we like this book. This is a really good book. We're going to publish it. And they said, oh, Larry, we're not going to publish the book. But, you know, it's really bullish and stocks have been coming down. So they published right here, How to Prosper from the Coming Crash in the Market by Bob Prechter. That was the week the book was published. Because that's what sold. I mean, publishers sell what sells, right? And the bullish book said nobody's going to buy a bullish book. So the bullish book didn't come out until about here. Finally, we got the bullish book published, and that's what took place from that book. We actually had to change the name of the book from Blast Off, Get Coming for the Next Bull Market, to How to Prosper. No, what was The Right Stock at the Right Time. What a dud of a title that is versus Blast Off, The Coming Bull Market. But they wouldn't publish a bullish book. But again, that 2-year phenomena, I wrote the book back in this time period. We wanted it to be published here. You can see what happened. And then coming to the next 4-year cycle low, and we got another 2012. You can move up to that. 2012, usually about October, look what happens. So 2022, some of you are going to still be trading, right? In fact, now you have a reason to live. The market is the best elixir of longevity in the world. There's nothing better than the market to keep you. If you're ever afraid of dying, this is what you do. You're going to have a big operation, something like that. You put on a massive contract, short the S&Ps, and you will wake up in the morning to know what happened. I guarantee it. You don't need a prescription for this. You just you don't even need medication. You'll come out of that trance in a hurry. Did I win or did I lose? This is a great business, and it's so neat to see this. Last weekend I was with Vic Niederhofer at something called the Speculators Party. A bunch of us get together in New York City. My gosh, I'm 73 years old. I was one of the young guys in the room. All these old guys are still in the market. You can still do this for the rest of your life. What a fascinating group of people. And that's one advantage of this, is you don't have to be a young kid to do it unless you're a day trader. But you know, most of us have grown up past that stage. Okay, all right. So there's another thing you need to look at in the market, and that's going to be the presidential cycle. I first wrote about this in my stock book in 1970. So again, this is something that's been around a long time. Yale Hirsch wrote about it earlier, and now his son Jeff Hirsch has carried on that tradition. Generally speaking, in an election year, and we've got one of those coming up, right, unless we get trumped for the election year. Some of you picked up on that. You know, the guy with a squirrel on top of his head, he's running for president. This is what usually happens in an election year. About May, prices rally, and just before the election, they really rally. It doesn't matter if a Democrat, liberal, conservative, whatever it is, we feel good. We finally, all the ads on television stop, and we're going to get back to normal life, and stocks start to rally. There's a lack of indecision the market doesn't like. As we get closer to the polls, we figure out who's probably going to win, or there will be a winner, and the markets continue to rally. So that's kind of a roadmap for this coming year during an election year. And you need to pay attention to this. This is how prices, on average, have traded. If we look at the post-election years, after they get elected, they really goose the economy. We have a nice run-up. Let's see now. Next year is 2016, right? The year after that is 17. And look what usually happens in the presidential cycle, the 1 year after the election, about July, August. So now we have a couple of things coming together here, don't we? Oh, the 7-year phenomenon that Larry discovered, and we have the presidential post-election year cycle also coming in. I don't know about you guys and gals, but I think in the middle of 2017, I'm going to be pretty careful about stocks. Does that make sense to you? Look what we see. Presidential cycle, 7-year pattern happening. Aha. So that's a focal point for us as short sellers and or to be in cash. The midterm election years, not much happened. There's usually a low in September. And the year we're all interested in now would be prior to the election year. Let's go to our next chart. This is what happens in the pre-election years. We rally up into about August, come down, drift, and at the end of the year, we start to rally really strong. So that's about where we are in this year. And it doesn't matter 10 years from now, you can go back and see where you are in the presidential cycle to see which one of these is most dominant for your year. we now know the most dominant one for 2016, 17, 18, going on into the future. This was all done by a student of mine, Dimitri Speck, who I met in Germany quite a few years ago, fell in love with the seasonal patterns and did a whole seasonal website on it, so you can go look at his if you want to, or everybody does seasonals now. It's become very popular. But now we have another little insight into how markets work based on the natural cycles. The big thing I like about this, I don't expect these are going to be perfect, but they give me perspective. And there's nothing that's been more important to me than to have perspective, because I tend to worry about the markets maybe too much. And if I have perspective that we're going to go from here to here, as we wiggle in here, I know where we're going, so I don't get worried about that. I don't get shaken out of my positions, because I know we're in a bull market on average that's in my favor to stay long, because I have perspective of the marketplace. Perspective is incredibly important. If you don't have perspective, then what happens? You don't know where you are. If we walked in this room and it's dark in the room and there's dangerous objects in the room where you could lose money in the room, right? You're really worried. You don't know what to do. That's the way the markets are for most people. You're in a dark room and you can't see, you have no perspective of where to go. You have no roadmap. The cyclical and time aspects give us a roadmap to help us stay on the road. We know most likely where we're going. So the presidential cycle, if we look at those years, the election year on average we've done 9%, 18 years have been up, only 8 down. The pre-election year, 21 of those went up, 5 have been down. That's the largest on average gain, 12.6%. The midterm election year, they're elected, they don't have to goose the economy, they can wait a little bit. So that's on average, how we want to handle presidential election. Obviously, it matters who the president is, who's in power, if they're going to spend money, not spend money, all the other stuff. But this just gives us some perspective of how markets actually respond to political conditions. Now, those of you who bought my forecast this year for 2015, or I think we did it 2010 as well, we actually have a short-term cycle that trades on the election cycle. I think this year it's had, I don't know, maybe 15 trades and been 13 winners, just because there are things that happen. The big trade coming up is right around Election Day. Prices rally to Election Day, pull back and rally again. So there are short-term trading opportunities as well. I'll be showing you a lot of those this afternoon.